Chapter 4: The Real Estate Trap. He is not a full man who does not own a piece of land. Hebrew proverb. Many of the truths we clinch to depend greatly on our point of view. Obi-Wan Kenobi, legendary Jedi Master. For most Indian investors, as of Mr. Talwar and Mr. Sanghvi, real estate remains the biggest asset by value in their portfolios. Both these gentlemen initially earned rich dividends from their investments in property but eventually faced major setbacks. Its large transaction size and value have meant that real estate has remained one of the largest components in most investors' portfolios. Most Indians associate property with safety, status, and prestige given the feudal traditions of our country. And yet, whilst real estate has traditionally been perceived as the safest asset class, it is anything but that. In this chapter, we will share how real estate becomes the biggest investment trap for investors. The residential real estate quagmire. For Indians, owning a house is seen as one of the prime necessities of life. Roti, kapda, or makan are critical priorities as far as Indians are concerned. However, while the first two are affordable, the makan has an element of aspiration packed into it because of the high prices of urban residential real estate. Until the mid 1990s, owning a house was restricted to very few well heeled families. This was an era where most jobs were either with the government or public sector companies. The employees stayed in the quarters offered by these companies. In that era, people typically built houses when they retired. A house was something which was built for staying, never as an investment. Fast forward 10 to 15 years, in the opening decade of new millennium, we saw a paradigm shift in the way retail investors started viewing residential real estate. For most of 2003 to 13, houses prices seemed to be on steroids, with prices moving up almost on a monthly basis. Along with the price rise, the other factor that led to a massive interest in the asset class was affordability. Interest rates came down significantly over these years. See Exhibit 30. Along with this, an increase in loan to value from 65 to 70% in the 1990s to up to 95% in 2004, and an increase in household income, along with the tax incentives from the government, meant that buying a house was within the reach of the more affluent middle class households. Exhibit 30. State Bank of India's 1 year deposit rates are a proxy for interest rates in India. The 2003 to 13 real estate boom established residential real estate as an asset class by itself. This is why Mr. Talwar ended up buying another house in Noida even though he owned the spacious flat in which he and his family were residing. In spite of the positive publicity given to this asset class in weekend newspaper supplements, in spite of the regular TV shows on investing in real estate, and despite the pitch from the friend who has made a fortune with his third flat in Mumbai, real estate is a uniquely dangerous asset class for investors for the following reasons. Number one, investment size. You can buy a stock for rupees 500 and a mutual fund for rupees 5,000, but you need to have a few lakhs with you for investing in the cheapest of properties. This makes real estate a rich man's asset class where high ticket sizes prevent widespread adoption of the asset class. Number two, liquidity. Compared to financial assets such as stocks and bonds, and even compared to physical assets such as gold and silver, real estate is an illiquid asset class. You can sell a stock on the exchange, sell gold to the buyers, or even barter a goat. But it is very difficult to sell a plot or a house. It takes several months, sometimes years, to arrange a buyer. In fact, as sellers in many parts of the National Capital Region and Mumbai have discovered after 2014, finding a buyer can be impossible at times. Number three, transaction costs. Stamp duty, registration, and other transaction charges associated with buying property now exceed 10% of the cost of the property. More often than not, the developer or the housing society also charge transfer fees. These costs make residential real estate the most expensive asset class to trade by a long margin. Added to that, the taxation. Short term capital gains taxes on real estates are at the marginal rate for the income taxpayer, and the long term capital gains tax is 20%. This implies that most of the gains from investing in real estate are lost via transaction costs and taxation. Number 4. Non standard assets. An ounce of 24 karat gold will appreciate at the same pace in your hand as it will in the hands of another investor. An Infosys stock will give you the same appreciation as it will to anybody who holds it. However, real estate is very non standard. It varies across macro markets like Mumbai versus Delhi, micro markets, Bandra versus Lower Parel, and even across streets and neighborhoods. This makes it a very unpredictable asset class, and returns are driven as much by luck as by thought out investment decisions. Number 5. A murky sector. Residential real estate is one of the least clean sectors in India. The multitude of regulatory clearances required to buy land, develop it, and then sell residential apartments make real estate an ideal sector for bribe seeking politicians and civil servants. Over time and over repeated transactions, rather than having a transactional relationship, many real estate developers have realized that they might as well work in the partnership with politicians, regulators, and civil servants. It is these people who are first in the queue to cream the gains from real estate. The middle class investor, no matter how affluent he or she may be, is the last to benefit from any upside associated with the real estate development in India. The above peculiarities are specific to the residential side of the real estate industry. As we will discuss further in this chapter, commercial real estate is quite a different animal. Why do so many investors get trapped in the residential real estate? In spite of the drawbacks in the residential real estate as an investment class, it remains the single biggest asset class for affluent Indians. The biggest portion of most people's net worth is invariably in one or more of the houses they own. There are several reasons for this. Number 1, a head start. Until the stock market came to the fore over the past decade, buying a house, buying land, or buying gold was the only known way to save and invest money. Compared to the familiarity of buying land or gold, investment in any form, either in the mutual funds or in stocks or bonds, is alien to most Indian investors. See the exhibit below. According to the RBI's Household Finance Committee report 2017, only 5% of India's household savings is invested in the financial assets, as against 77% is in real estate. As a result, residential real estate occupies a much larger mind share for Indian investors than any other asset class. Exhibit 31. The allocation of household assets in India shows significant skew towards real estate. Real estate 77%, gold 11%, durable goods 7%, and financial assets 5%. House prices only go up. Unlike the other asset classes like equity and debt, which can have a cycle of 3 to 5 years, that is, price movements change their trend every 3 to 5 years, real estate runs into super cycles of more than 10 years. So, most people who made significant profits in the bull cycle of 2003 to 13 don't have any experience or memory of a downward cycle. As a result, they get caught in the belief that real estate prices can only go up. The fact that there are no reliable real estate prices indices helps to propagate this myth in India, one that is held by millions of Indians. However, veterans who saw the real estate crashing of the late 1990s know better. Thanks to an article published in the Indian Today in August 1997, we have some data on how prices crashed in that era. Exhibit 32, Price Correction in Major Indian Cities between 1995 and 1997. Number 2, the lure of magnificent returns. One of the reasons for even the most hard nosed investors find it hard to ignore real estate is that the asset class made a tremendous money over 2003 to 13 as the house prices in most locations went up as much as 5 to 10 times. For example, property prices in Gurugram sector 49 rose 6.4 times from 360 rupees per square feet to 8,670 rupees per square feet during the golden decade. Elsewhere in Lower Parel, Mumbai, a flat selling for 4,500 rupees per square feet in 2003 sold for 35,000 rupees per square feet in 2013, going up 7.7 times. For most buyers of such properties who used a mortgage, the return on the amount invested or ROE is mind boggling. More importantly, outsized gain on the scale leave a lasting imprint on not just who those who made the gains but also on their friends and relatives. Envy is a powerful emotion. However, as we learned subsequently, 2003 to 13 was the best period for residential real estate in India, and in all likelihood, it will be a long time before we see another such period of price appreciation. In fact, in a downward pricing spiral, investors in an illiquid and tax unfriendly asset class such as real estate can really get squeezed on their mortgages as their modest equity is wiped out by the drop in the price of the property, a phenomenon known as negative equity. Number three, absolute returns versus compounded returns. All investment decisions have to be considered relative to their opportunity cost. Most real estate investors are usually satisfied simply because they look at absolute returns in isolation. Thus, an investor may have a very fond memory of his property going up by 5 times in the last 20 years, but the compounded annualized return that property has generated over the last 20 years is just 8.3% per annum. In that same period, the Indian stock market's benchmark index is likely to have risen at 15% per annum, which compounded over 20 years translates to a 16 times return. We have lost count of the number of real estate millionaires we met in India who have never done this opportunity cost comparison. The coffee can in real estate. Investors who invest in real estate, because most of them burn their fingers in stocks, they usually see real estate investments as being safer than their stock investments. What they don't realize is this because of the inadvertent coffee can style of investing. Coffee can style of investing that they adopt in real estate as against the trading style in their stock portfolios. That is, when it comes to real estate, investors are happy to buy and hold for long periods of time. As a result, they end up holding their properties through thick and thin, which is why they are able to see an appreciation in the value. In contrast, in equity, investors typically end up buying at peak, trade frequently, and then exiting at the bottom. The harshness of most investors' experience of the stock market versus their happier experiences in the real estate is, therefore, in part self inflicted rather than being due to underlying nature of these asset classes. Chalk and cheese, commercial real estate versus residential real estate. Commercial real estate also has two sets of buyers, the end users and the investors. With end users, that is simple equation. For them, real estate is simply a capital expenditure or a cost which has to be incurred, and these costs have to be seen relative to the return that the business generates. If business don't want to incur the heavy upfront cost associated with real estate, they end up renting the premises or moving the cheaper location. On the other hand, for investors, commercial real estate is a really interesting asset class as it offers a mix of rental yield and capital appreciation. For most affluent investors, investment in commercial real estate is in the form of shops, office units, and small warehouses. This mimics the residential reality investment style in the size and locality of the investments. Ultra high net worth investors also have access to what are called the Grade A office buildings. Grade A offices are large, modern, and top of the line buildings typically built in the most prime locations. These are typically occupied by blue chip Indian corporates or multinationals and are the benchmark for commercial reality in our country. Thus, one would measure growth in the grade A property area to ascertain how commercial property as an asset class is doing. However, the ticket sizes associated with such deluxe office buildings are large. In Mumbai, it is upward of rupees 10 to 20 crore for a single floor plate. Hence, the key investors in these type of properties are large Indian developers like Raheja, Embassy, Prestige Estates, and DLF, or very large foreign funds like GIC, Blackstone, Brookfield, and Canadian Pension Plan Investment Board. In fact, foreign players are the largest investors in Grade A property in India, with Blackstone alone holding 70 million square feet in the country. With even single floor plates at times costing upward of 20 crore rupees, only a few ultra high net worth individuals have the capacity to invest in such projects. For others, investment in Grade A properties has been through real estate funds, which are actually pooling vehicles for clubbing together many dozens of investors. Rental yields from commercial properties are a function of property prices and the underlying interest rates in the country. At 7 to 9% today, these gross yields are far higher than 1.5 to 3% yields that residential real estate has to offer. Whilst an investor in commercial real estate also hopes for capital appreciation over time, given that the capital appreciation associated with the asset class forms the lower proportion of the overall gains, commercial properties are far safer investments than residential real estate, where capital appreciation is pretty much the only source of gains. Commercial real estate prices have been less volatile in India than the residential real estate prices, primarily because of the interplay between two forces. Firstly, the end users of commercial real estate have been businesses. For these businesses, it is imperative to make profits, and if the cost of a particular building or location is too high, they will consider moving to some other building or location. This rational frame of mind is very different to the mindset of the residential real estate investor who invests in an overvalued asset and still expects the future price of appreciation irrespective of the current cost of the property. These contrasting mental frameworks have created a remarkable anomaly in the Indian real estate market. For example, in Mumbai's Lower Parel, which is now a thriving central business district, commercial properties prices are half that of residential properties. Given that the land cost and quality of construction are more or less the same for both sets of properties, it is baffling why commercial properties, which give rental yields that are 5 to 6 times that of residential real estate, should be selling at half the price. This again shows the absurdity in the residential real estate asset class and warrants extreme caution from investors. How can investors access this asset class? As described above, for investors, real estate is no longer just buying physical properties. Today, an investor can participate in the sector through multiple ways other than simply buying the property. Real estate private equity funds. Real estate private equity funds give funds to developers in exchange for equity. The funding could be at developers holding the funding and hence the equity could be at developers holding company level or for specific projects. When it is for specific project, it is also known as SPV, special purpose vehicle funding. An SPV is typically company that developer incorporates only for execution of one or more specific projects. Since it is an equity investment, the investor gets full participation in the SPV's fund's profits. However, the flip side is that the equity investor has to bear the downside as well. While prices usually don't crash, projects typically get delayed. This increase in the duration of the project means that the equity investor's return plummets as the return comes much later than the investor expected. For example, an investor may get rupees 150 back on an investment of rupees 100. If the money comes back in 2 years, it is compounded and annualized return of 22%. However, if the same money comes back in 5 years, maybe because of the local government took longer than expected to give the occupancy certificate, the investor's compounded annualized return drops to paltry 8%. Investors who get an 8% per annum from investing in real estate will justifiably feel hard done by, as they might have made more money from investing in a fixed deposit than in a high risk venture like a real estate project. Private equity funds burst into the scene in 2005 to 6 and saw many launches in the next few years. These funds typically had a tenure of 5 to 7 years. However, almost a decade later, many of them are yet to return money, and almost none of them gave the kind of returns they were aspiring for. In that sense, the first outing of real estate private equity funds in India has been nothing short of disaster. Rental yield funds. These funds emerged in 2008 with the objective of investing in commercial property and earning the high yields that were offered. These funds were typically of lower tenure than the private equity funds since they were investing in ready properties. In that sense, they also did not carry the development risk. These funds hoped to also earn capital appreciation apart from the annual rental yield, which is supposed to make the overall interest rate of return IRR very attractive. Again, like private equity funds, these funds also fail to deliver. To be fair, rental yield funds have had fewer disasters than private equity funds. While the thesis for rental yields played out, the lack of exit opportunities meant that the funds dragged on far longer than their intended tenure and sometimes had to sell their assets at a discount to the price to be able to give money back to the investors. Non convertible debentures or real estate debt funds. Around 2009, when interest rates were very low in India, liquid funds were giving 6% per annum returns. Real estate non convertible debentures (NCDs) emerged, offering a high return. NCDs are similar to bonds issued by borrowers which promise to pay a certain coupon along with the principal back with the predetermined tenure. They were issued by real estate developers, typically at a project SPV level. The high interest rates were offered anywhere between 18 and 25% was because these projects could not get funding from the banks, and often while the collateral was project, the end use was buying land elsewhere. Unlike private equity and rental yield funds, there was no capital appreciation expectation, and thus, technically, the investor was assured of his compounded annualized return. This made NCDs extremely popular among investors and led to massive issuance from developers. See the exhibits below. This was soon followed by funds which pooled investors' money and invested it in multiple of NCDs. They offered diversification, which made the investment seem less risky. Exhibit 33 NCD issuance has rocketed in the last few years. Exhibit 34 risk associated with NCDs has risen manifold as reflected in the yields being offered. The party continued for a few years, but it was soon clear that debt with such high servicing costs was unsustainable, and builders desperate enough to borrow at such high cost were not in a position to return money to the clients. Then the musical chair of refinancing this high cost debt started. It meant issuing a fresh 3-year NCD to take care of the maturity of the existing one. Assuming an 18 to 20% per annum cost of the interest servicing, the profitability of the real estate project had long gone out of the window, and the objective was to somehow prevent or postpone default as long as possible. The NCD market is now at a stage where refinancing has slowed and we are seeing defaults in various projects. The reduced appetite for residential real estate demonetization and the widespread crackdown on black money has not helped. REITs, or real estate investment trusts, are structurally similar to mutual funds in that they pool investors' money and invest in real estate projects. However, there are few differences between REITs and mutual funds. Most importantly, REITs are allowed to invest in income bearing assets only and mandated to return more than 90% of the rents they get as annual income to investors. The pooling gives an excellent opportunity to investors with small ticket sizes who cannot afford to invest in a single property. It also diversifies the risk across multiple projects and is tax efficient. REITs are extremely popular in developed markets. Their evolution is an indicator of the potential and future path of real estate investment in India. While the Indian regulators SEBI and the government have been keen to bring REITs to India, progress has been extremely low. The last hurdles in taxation are being cleared only now. In VIT, similar to REITs, but what's the underlying asset being in the infrastructure space have already been launched and are traded in the Indian stock market. REITs should follow soon. This will bring far more transparency and broader retail participation in the real estate market. Several large foreign funds that have invested heavily in commercial real estate are expected to monetize their assets through REITs in the coming years. Busting the myth, real estate as an asset class is safe as a house. Lessons from the world. Investors across the world, especially in English speaking countries, have a fascination for real estate as an asset class and for reasons not too different from what we discussed earlier in the chapter. However, we have far more comprehensive data for the developed markets than for India, and thus it becomes far easier to apply cold logic to these markets. In the US, for example, data is available from the early years of 20th century and throws up some startling findings. Since 1990, real estate in the United States has given an annual compounded return of 0.4% as against an annual return of 5% from the Dow Jones, with the standard benchmark of the US stock market. Exhibit 35, Dow Jones has real estate return in the US since 1990. Dow Jones versus real estate returns in the US since 1900. $1 invested in Dow in 1900 would have become 30,447 in 2017. This compares to the only return of $161 if the dollar was invested in real estate. The story is not unique to the United States. As can be seen in the exhibit below, a real estate hardly gives returns over the long periods of time. Since 1980, American and German real estate have given compounded annualized returns of 3.8% and 2% respectively, while Japanese investors have hardly made any money at all from the real estate. Exhibit 36, Real Estate Returns in the Developed Markets. Real estate has time and again gone through boom bust cycles across the world. Unfortunately, because these cycles are long, investors tend to forget the previous busts when they are in the middle of a boom. And the length of these cycles, alongside poor data availability in an emerging market like India, prevents them from developing a deeper understanding of the tricky asset class. Exhibit 37. Real estate crashes in the recent history. Country, quarter of the peak, quarter of the trough, number of quarters, peak to trough. USA, quarter of the peak, Q2 2007, and quarter of trough is Q2 2011, number of quarters 16, and peak to trough is 16.3% negative returns. Denmark, it's 9 quarters, 17% negative returns. Spain, 14 quarters, 18.2% negative returns. Sweden, 10 quarters, 20.9% negative returns. Switzerland, 41 quarters, 25.2% negative returns. Norway, 20 quarters, 25.8% negative returns. Finland, 15 quarters, 36.9% negative returns. Netherlands, 16 quarters, 32.8% negative returns. Ireland, 16 quarters, 44.2% negative returns. And Japan, 82 quarters, 49.1% negative returns. In India, most residential real estate is unaffordable. Adjusted for earnings, Indian property is easily among the most expensive in the world. The exhibit below shows the price of 1 square meter of residential properties as a multiple of GDP per capita. Judging by the simple measure of affordability, India is the most expensive residential real estate market in the world by gigantic margin. Clearly, these levels are unsustainable and unless, of course, India's GDP per capita skyrockets tomorrow morning. In the absence of such GDP growth, residential real estate prices in India have nowhere to go but down. Exhibit 38. Affordability as measured by price per square meter as a multiple of GDP per capita.